I'm still bullish gold. I'm not saying getting shorter, but sorry, I just cannot go out and say it's going to go to 5,000. There's certain times you have to kick in the discipline. So then I'm looking for all the next indicators, and that's our right now. We're just hovering at these great levels. Gold at 4,000, yeah, that's great, but it's really scary to stay this stretched, and that's why I'm just looking for the next indicator. So I'm quite simple right now.
My gut is telling me that 20 to some odd percent of supply constraint may very well on the margin, could very well be right, which is where I came up with 5,000 as my new 2,000.
Gold's recent rally to the $4,000 level has reignited debate across global markets. Some analysts view this as the beginning of a multi-year revaluation. In contrast, others warn that the metal is stretched far above its long-term moving averages and is due for a correction. Yet beneath the short-term noise lies a structural shift. Global liquidity is thinning. The U.S. fiscal deficit continues to balloon, and non-G7 central banks are steadily accumulating gold as a form of monetary insurance. This isn't speculative hype, it's the steady unwinding of a 50-year experiment in unbacked money. McGlone, a senior macro strategist known for his disciplined approach to commodities and risk management, emphasizes that while gold remains bullish in the long run, it's showing technical exhaustion similar to the peaks of 2008 and 2011. Dave Weisberger, a veteran market analyst and CEO in the digital asset space, adds that the doubling of global money supply, combined with unprecedented central bank gold buying, justifies higher valuations, possibly pushing gold toward $5,000 over the coming years. Both analysts agree that structural changes in global liquidity and reserve accumulation will define the next phase of this cycle, not speculative momentum. We are entering the late stages of a monetary era in which tangible assets are reclaiming their role as real stores of value. The disciplined investor understands this shift and positions accordingly. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold's hovering at this 4,000 level. So not to push back on Dave, I just have to kick in my risk manager discipline of gold. As I look at it right now, it's the most stretched above its 40, 50, and 60-month moving average since 2008, right before it corrected 30%, and 2011, which put in a high for about 10 years. So yeah, I'm still bullish gold. I'm not saying getting shorter, but sorry, I just cannot go out and say it's going to go to 5,000. There's certain times you have to kick in the discipline. So then I'm looking for all the next indicators, and that's our right now. We're just hovering at these great levels. Gold at 4,000, yeah, that's great, but it's really scary to stay this stretched. And that's why I'm just looking for the next indicator. So I'm quite simple right now. If we can keep at Bitcoin and get above 110 and stay above there, maybe MicroStrategy to alleviate some of its oversold condition. We all know it's getting a little too beat up. Can maybe get back to its 200-day moving average, which is heading lower. The Bloomberg Galaxy Crypto Index, 200-day moving average is heading lower. They're all following what I saw in crude oil and the grains. And my point is something's got to shift that. To me, we're getting towards the time of the year. The risks are, yeah, sure, we might end the shutdown, and then we're going to get all that data. It's probably going to be pretty bad. So I'm looking at, show me the beef, show me some indicators, and that's why I'm worried about. Bitcoin's got to get above 110. Otherwise, it's the leading indicator for me for everything.
When you look at gold, I look at it and say, yeah, you're right. In 2011, we got to damn near, didn't quite hit 2,000. I think it hit like 1,900. I don't know. I bought gold for the first time in 2003. So I was quite giddy in 2011. I remember that. And I held it, etc. But the money supply, our total monetary aggregates have more than doubled since then. Globally, actually worse than that. And at the same time, we decided to impound dollars from a variety of countries, which has made central banks say, we need to permanently hold more of this other thing as reserves. And so when you look at those structural changes, you could make the argument, if it wasn't for the U.S. Censoring dollars, that if it wasn't for that, I would say you're right. I think gold, at 4,000 lines up almost exactly. And so, but the problem is doing analysis, which says, okay, 4,000 is the new 2,000 because we've doubled the amount of money in circulation. I would be right there with you, but that would be ignoring a very important structural driver, which was central bank buying, which from countries that are not G7, right? So non-G7 central banks that's a permabid, right? That's not changing. And that you could put your own math on. I basically tried to come up with some model, and I researched all sorts of people, couldn't come up with anything definitive. My gut is telling me that 20 to some odd percent, of supply constraint may very well on the margin, could very well be right, which is where I came up with 5,000 as my new 2,000. But yeah, I mean, you're right, Mike. Markets get extended. Trees don't grow to the sky. The difference is if you flip over to Bitcoin, we are nowhere near those levels. We have yet to see the rally from this quote cycle. We saw literally a massive increase in demand by opening up the financial system. And what happened was way less than most financial models would have predicted. Why? Because we've entered a new phase in Bitcoin. It's called distribution. And, there've been, everyone's talking about that well-written article, by, I forgot who it was.
Yeah, the IPOs. Yeah.
Let's talk about, what's changed since our last macro Mondays on Monday. We had almost a complete Democratic sweep in the elections, and the number one issue was affordability or inflation. That's a lose-lose for Mr. Trump, because the number one factor for all inflationary factors now, on an unprecedented basis, only really 2 times in history, is the U.S. stock market. It's 10, and it's going up. It's creating more inflation. It's 2.3 times GDP. It is the economy now, and that's his bias. We want a higher stock market, but we don't want inflation. This is a lose-lose for Mr. Trump, and that's my point. Is what I think I'm showing signs of the end game. So the Fed started cutting rates on September 17th. Since that date, 10-year note yields are up about 10 basis points. Bitcoin's down about 10%. If that's not going to help Bitcoin, what is? And the stock market's hovering up around 2%. So my point is, we're at the end game. We're near it, and Bitcoin Gold's telling me that Bitcoin versus a broad basket of cryptos versus precious metals are telling me that. And now it's just about one little thing: the stock market has to stay up, and that to me is what this declining Bitcoin to gold ratio is telling me. Declining MicroStrategy, and I hope you're right. I hope by the end of this year or so, can say, yeah, we're above 110. I think we're more likely to be back down in the year, which is below 94. It's just this is where things are leaning now, and I look at it as a trader. Give me a rally, I'll sell. It's certainly happening in things like crude oil. Give me a rally, I'll sell it. Give me rallies on crude oil and Bitcoin. I think people are looking to sell because they're realizing this failed performance. Yes, that's the point that you made, Dave. James and Dave. It was up a lot last year, but this is what commodities do. Remember, Bitcoin's not even a commodity. It's got millions and millions of competitors. This is something that's never happened. Let's talk about what's really happening. Millions of competitors, and it's showing poor performance. Is that going to just shift on a dime with the Fed easing? And the Fed already said they're going to stop easing. I'm talking about an end game here of risk assets going up.
Bitcoin has been in a consolidation phase since January. You can't. I mean, you can say anything you want. You can call that poor performance, call it whatever the hell you want to call it. I don't care. Doesn't matter. And by the way, it could continue for another 2 or 3 years. It could continue a very long time. It's based on information we don't know, which is how much supply. What's the supply demand curve look like for Bitcoin? All these people who predicted Bitcoin will go to the moon immediately effectively assume that because it's a constrained supply, they just assumed that it's inelastic to price. Well, if there's one thing that 2025 proved, is Bitcoin is not inelastic to price. There are holders who own it who actually reacted very strongly to the price being over 100,000.
The divergence between crypto assets and precious metals is sending a clear signal about what's coming next in the broader market cycle. As global liquidity tightens and equity valuations stretch to historic extremes, speculative assets are beginning to show fatigue. Meanwhile, hard assets like gold and silver, anchored by tangible scarcity, are quietly reclaiming investor attention. The imbalance between the unlimited issuance of cryptocurrencies and the finite nature of precious metals is becoming increasingly difficult to ignore. Overlaying this trend with U.S. stock market capitalization relative to GDP reveals the same overextension seen before previous corrections. When that ratio declines, it typically signals a broader repricing across risk assets, including digital tokens. Precious metals, however, tend to rise in those phases as capital seeks stability over speculation. The setup forming now suggests that transition is already underway, and when it accelerates, it will redefine the market landscape. Let's get back to the interview.
So this is a chart of the Bloomberg Galaxy Crypto Index, which I initially suggested here, divided by a basket of precious metals. There's only 4, and there's no going back to 2017. We can agree there's basically no trend in the basket of the cryptos divided by a basket of precious metals. The difference is an index will always have a survivor bias. Not bias. Now, right now, there's millions of cryptos it can choose from. It'll take the top ones, but it always have a survivor bias. That should be great for an index. There's no survivor biases for precious metals. There's only 4 precious metals. My point is, I will make a prediction that this chart will go down next year, meaning the basket of all the basic cryptos, anyone you want to look at, even Bitcoin, on any time of measured basis, will drop versus precious metals. And there's one key reason I'm making that is I'm just overlaying this U.S. stock market cap to GDP. I think at some point this is going to go down. It has in the past, oh my gosh. But when it does, we're going to see most of these cryptos go to zero, which is overdue. And then we'll have a great time to buy. That's just my base case now. I should not be buying anything in cryptos, mostly Bitcoin. The rules of economics will apply. Unlimited supply is never good for any assets. Let me finish. And they will get through that period. I think it's starting now is my fearful. And that's why so far, just that VIX going back to 20, yeah, it's hanging out there. Just Bitcoin dropping down to 100,000. Those are shots across the bow. Now they got to really stop doing that. Otherwise, things like MicroStrategy are just telling you where things are going.
Well, so, Mike, how many cryptos are in that index?
12. So there's only 12, and it can track millions, but that's the point. It's only going to track the ones that are doing the best.
Those 12 are likely none of those 12 are going to zero. But
here, this chart is perfect. Keep it up on the screen. We are almost exactly in the middle of the range. So so what you're basically saying is, and my expectation is precious metals and crypto all go higher because, by the way, we're printing money. We're going to print more money. So bias it upwards and everything, not this chart, but the precious metals as well, because you can be bullish on both. But we're right in the middle of the range, meaning that it was overbought and now it's back to even. Now, here's the thing: overlay this with the growth in the Bitcoin network that we talked about before, and tell me what's going on. How much of this is Bitcoin dominance going in one direction? How much of this is our other factors? Bitcoin and Ethereum has been driven by Tom Lee. And we all understand that. But if you look, really, if you just did the chart Bitcoin versus gold, I think you see a very similar chart. So that's which is effectively it's right back in the middle, and both are biased, but it's ignoring the growth in the Bitcoin network completely.
So can I point out, here's what the thing is. Here's the thing: it's going down despite the stock market going up. That's the problem. That's showing the divergent weakness. Hold on. And you have to make the point is either cryptos are going to catch up or the stock market's going to go back down. And when you get the highest ever, you probably just have to take risk off the table. And to me, that's what gold is telling me this year, that you're supposed to just say, get out. Thank you very much. I'll clip my coupons in treasuries.
Great. And that's wonderful for you, except for understand corporate profits look almost exactly the same as stock market to GDP. Corporate profits to GDP are up just as much. So once again, stock markets are effectively discounting future cash flows from corporations, and the future cash flows from corporations are up that much. Does that mean that you'll be wrong? No. Corporate profits could nosedive. We could do things. We could elect President AOC and
going that way.
And if you do that, then the S&P could lose 50%. But what will actually happen is not that corporate profits will nosedive, because the left and the right are one party, and they both take a lot of donations. And we've seen this in the healthcare fight, and anyone who wants to understand that, we talked about that a lot this weekend. I mean, we have enacted rules to benefit large corporations over small and make the big companies in the S&P do better. But you can't spread this chart of the stock market to GDP looks like, and when you look at that chart, if that's the only thing you looked at and the only data point you look at, you would sell everything and clip coupons 100%.
So, but I also do the same thing compared to this U.S. stock market versus the rest of the world. It's the same thing. The difference is U.S. stock market versus the rest of the world has started rolling over. U.S. stock market versus gold has started rolling over. The only thing that really hasn't started rolling over, unless this is the beginning of it, it's a monthly chart, is U.S. stock market versus GDP. So I'm using different measures, but just how about U.S. compared to the rest of the world? I mean, it's the highest ever.
Yeah, no, it's true. But U.S. corporations have been outperforming. Why? Because they're selling to the rest of the world, that we globally dominate in a bunch of industries that the last time when Clinton was in the White House, he didn't try to destroy the tech industry. He did exactly the opposite of what President Autopen did in terms of crypto and digital asset. And understand that is why. I mean, we talk about the Mag 7, as reference. The Mag 7 doesn't exist if the policies in the late 90s were the same towards technology and the internet as they were towards crypto. in the previous administration. So understand, we're benefiting from that. And honestly, I don't know that if it wasn't that Elizabeth Warren won't be put out to pasture in the next administration anyway. So we'll see what happens. But the truth is, corporate profits are what matters. And yeah, they're at risk if policies change. But as long as we're deregulatory, I mean, forget the government shutdown. What was the projected GDP growth for 2025 before the government shutdown? It was 4%, right? What's 2026 going to look like with the government up and running and an emboldened Trump trying to deregulate even faster and printing even more? Those are the things that you have to look at. But that's where charts kind of could be difficult. Is there a crash at some point in corporate profits because we do stupid things at a political level? Quite possibly, but not now. And markets, unfortunately, they claim to be a discounting method for the future. We all know the same reason that they look at the University of Michigan survey.
The rotation away from speculative assets toward tangible value is no longer theory, it's unfolding in real time. As digital markets lose momentum and liquidity tightens, the financial system is quietly reverting to fundamentals. Precious metals, which have been undervalued for years, are starting to regain their status as the ultimate store of value. This transition won't happen overnight, but once confidence breaks in over-leveraged risk markets, capital will flow into hard assets swiftly and decisively. The ratio between crypto and precious metals highlights this shift clearly. Every time global liquidity contracts, gold and silver strengthen against digital and equity-based assets. The next phase is not about hype or network growth, it's about survival and credibility. The coming years could mark the largest repricing of tangible wealth in decades, and only those positioned ahead of the move will benefit from it. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.